Funding sources. When starting a business, there are many ways to finance operations. This list is not complete, but it represents the main ways businesses are funded.
The table below details some of the funding sources that are available to start up businesses. Now there's cash flow, which is also known as bootstrapping, and the timing is immediate. The advantages are obvious. There's no interest payments to make or financing to secure. The disadvantage is that your product or service must make money from day one. You could be self-financed, and the timing of that is quick. Again, you don't have any interest payments to make or financing to secure, but you could run out of money, making it harder to get financing later. Friends and family can bring money in weeks to months, with no interest or low interest payments and no banks to deal with. The biggest disadvantage is the hard feelings factor that could be very high if you don't succeed. Remember, you're going to be seeing these people at Thanksgiving and Christmas, so only take money from them if you're sure you're going to make it. Then there's bank financing, which takes 60 to 120 days to receive. The good thing about bank financing is there's minimal interference with your operations, and it builds your business credit. The disadvantage is you must have a FICO score above 680, and you could lose more than your business assets if your business fails. There are community development companies, also known as CDCs, and the timing for funding from them is 60 to 120 days. The advantage can be that they have special access to little-known programs to finance businesses. The disadvantage is that most CDCs are primarily interested in financing real estate or equipment. Investors can bring funding within weeks to months, and they can provide important guidance and support to a new business. But the big disadvantage is they can be meddlesome and interfere with operations. Another disadvantage is they can force outcomes to business situations. The most important being they can force you to sell your business if it's advantageous to them. If you want to start a business that you're going to run for the rest of your life, an investor is going to be a hard sell because they need an exit strategy, usually in a 3 to 5 year time frame, and usually bringing 3 to 6 times return of their money. Then the last source is grants, and they take from weeks to months as well. In many cases, no repayment of the grant money is required. The disadvantage is generally they're for non-profit businesses only, and heavy research is required to find and apply to them. And most of them have public policy objectives that you need to meet. In other words, the grant will be to provide a certain service to a certain population in a certain area, not a generalized grant to allow you to buy marketing or to make your business succeed.
As a general rule, a startup business that is fairly common, for example, a restaurant, an auto repair shop, or a retail store, can be taken to the bank for financing if the borrower has a FICO score of 680 or greater and has dollar-for-dollar assets to collateralize the loan. What this means is if you need to borrow $100,000, you would need either $100,000 of equity available in your home or other assets worth that amount that you can pledge to the bank. You can also have guarantors. These are people who will pledge their assets and will pay in the event that you cannot. Businesses that are not common, that have a new concept or are run by people who have credit problems, generally need to find investors. Investors can provide you with the capital that you need, but most will have requirements that a bank won't have. The most common requirement is that you provide an exit for the investor. That is a way for the investor to recover their money plus profit at a particular point in time. Investors usually get into businesses that are looking to be sold or become public companies, for example, traded on the stock exchange, so they can make their money back. Few investors are willing to get into a company for the long haul while you run it. Determine how you will fund your business, what you will have to offer a bank or investor or other person willing to assist you. How and when will you pay them back? Now we have discussed what a business plan is and why you would want to create one. We have discussed the basic sources of funding and their requirements. We've also talked about what you need to think about before committing to a business plan and going forward with what could be the greatest adventure in your life, starting your own business. Next, we will look at how to create financial projections.